Tony, thank you for being here. So 40,000 out of how many? Is it pretty much across the board? Just give us a sense of the percentages here. And then also any color you can provide on where the price increases are really the steepest at this point in time.
Sure. Happy to do that. Good morning, Leslie. 40,000 is the vast majority of the items that we would actually provide to the marketplace. So we're seeing it across almost everything. We just came off of our fall expo here this week, and there was a lot of energy and a lot of excitement about driving the business in the fall. But the buzz, of course, was around the supply chain shortages that still exist, around labor shortages, and of course this dizzying pace of pricing that's going on right now.
So that all sounds like it's stemming from the supply side of the equation. What about the demand side? Do you feel like there's any destruction starting to take place, or do you think demand is still pretty strong and that consumers are willing to pay up for these higher prices?
Well, it's a little bit of a mix, I'd say. So we're seeing consumers actually staying pretty robust in the marketplace. We're seeing a little bit of units down, but we're also seeing them making productive choices as they move into items that are not priced as aggressively. For example, we're seeing about 2x the growth on our private label brand, Our Family. That brand is actually seeing great growth. They're high quality products that have better availability than a lot of the national brands, and they're priced more aggressively. So we're seeing people make those choices as they come in and shop our stores.
Tony, what do you make of some of the declines we're seeing in very specific types of consumables? I'm thinking, for example, the outright deflation in chicken wings. We know what corn and wheat have done at the commodity level. Do you think is the logjam in the delivery? And if that's the case, why wouldn't that also be getting better as we see freight rates and energy prices come down?
You know, a lot of the items that are seeing some of those deflationary experiences are more agriculture. They're more cyclical and seasonal. But we're seeing at center store really pretty aggressive pricing across the board. And we're seeing that in some items that are also pretty close to agriculture, like eggs, like a lot of the dairy products. So the overall inflationary picture is still pretty high. And we're working very aggressively with our suppliers right now to help contain that. We've actually launched an overall transformation of the way we engage with our food manufacturing partners. And we want to get back to winning the way we won before the pandemic. And I think that we're confident they'll want to do that with us as well. But we want to actually make sure that we're not adding to collectively, this industry is not adding to the inflationary pressures. And we're using a very reasonable justification for those price increases.
Right. Do you think, is labor a big part of it? Because if it is, then that's going to be what some argue is a stickier problem in terms of returning supply to the market. If we really are in some sort of structural change in the way in which we get labor into the labor force.
I think it's precisely right, Carl. Labor has been the driving issue about the cost pressures that companies are feeling right now as they're trying to get the folks to run their shifts, get the shifts running, and and attract people. That's cost more money. We saw that over the course of the last year plus about 20% pay increases for our frontline, for our entry-level roles. And that, of course, has put cost pressure on us. And we're hearing the same things from our suppliers and from other folks in our business.
Wow, 20% increases. That's definitely about double where inflation is. Thank you, Tony. Appreciate it.